Welcome to Should I Change My Retirement Investments Because the Stock Market is at an All-Time High? I'm Jeremy Kyle. You're on my Mr. Retirement YouTube channel. And of course, the stock market is at all-time highs. Let me check it today again, August 26th. Dow touches new record. S&P pulled down by tech, but it's right there near new record. So that's a question a lot of people have been asking me is what should I do now that the stock market's at an all-time high? And I'm glad you're asking me that question because much better to ask the question of what to do with your investments when the stock market's high compared to when it's low, which is unfortunately what happens a lot of times. So ask any questions you'd like in the chat. That'll be in there, ready to go. I'm monitoring that. And I'm going to give you 5 action steps to take with your retirement right now, now that the market is at those all time highs. Before I do that, let me just tell you a bit about two different people I met in the fall of 2019. Met them, I think, even the same exact week. Uh, they both said they wanted to retire. The first one said he wanted to retire April 1st. Met them in fall of 2019. He wanted to retire April 1st of 2020. Uh, but then he says, "Well, I like you. I'm going to use you as my financial advisor, but I don't want to pay you till April 1. I don't want to pay you for 6 months." Um, that was his choice. And then he actually called back, and we set up a meeting mid March of 2020. I met him on a Monday, mid March of 2020. We scheduled a time 2 weeks later to meet. We said, let's just do this by Zoom. Who knows what's going to happen with this COVID thing? So let's go with Zoom. Uh, Zoom happens, but he doesn't show up 2 weeks later. Took me another 2 weeks to finally get a hold of him and his wife. And they said, funniest thing happened. We met with you Monday night. Well, Tuesday night, we are starting to feel sick. Wednesday morning, we wake up with basically the worst flu we've ever had. We had COVID. We've had it horribly for 3 weeks. Of course, now it's April 1. He said, I know I told you I wanted to retire, but now that my investments are down over 20%, I don't know that I can retire right now. So that's April of 2020. He just called me back a few months ago. So that's a few months ago in 2024, 4 years later. He said, I just retired. Let's work together. And so here he is, wanting to save a few bucks, I suppose, by not working together on some planning ahead of time in fall of 2019. He ended up retiring 4 years later than he expected because the market accidentally dropped more than he expected. The other clients I met fall of 2019 as well, they said, I want to retire 2 years from now. And we're just kind of middle of the road investors, and we want to get ready for retirement. So I met them. They started working with us, and I discovered a couple of things. The first one is that they said they're middle of the road investors, but their advisor had them 100% in the stock market. Every single investment they had was stocks. I also thought too, you'll learn about these in some action steps. I said, you're retiring a couple years from now. Who knows if the market will drop? Let's just set aside some money for the short term, kind of out of the stock market in case the market drops. So that's what they did. So we set aside some money. We brought down the risk on their other investments. And he called me quite a bit in March of 2020 and April of 2020 saying, the market's down. What do I need to do? I kept reminding him saying, hey, we already did it. We've already done what you needed to do. You've got this money set aside and you did bring down the risk already. You don't want to bring the risk down even more usually if the market's already down. And he said, yep, you're right. I'm glad we did this planning. Well, he retired on time the 2 years later than he expected. And I think a large part of it had to do with he had that money set aside. He did not feel like he had to do any panic selling when the market dropped. And so here we are, the market's at an all time high. I want you to go ahead, do some planning. Of course, you should always be doing planning. And I think the best time to plan is ahead of time when the market is high as opposed to later when it's down. And here we go. We got 5 steps, 5 action steps to take now that the market's at an all time high. I've already mentioned a little bit before with my examples there, real life examples. where you've got to decide if you're going to set things up with a short-term investments and a long-term investments. When you're planning for retirement, you generally only have long-term type of investments. And I think you still have long-term investments in retirement. It's just now you have short-term investments as well. You went from only having long-term to having short and long-term. I think that's a mistake some people make is they believe they only had long-term and now everything's short-term for their investments. I think you have both. And in my opinion, you can't have long term investments unless you have short term investments because you might need some money in the short term for it. So that's step number one is decide how long is your short term, right? Do you want to look at the money you need 1 year, 2 year, 5 years, 10 years from now and say that's short term? I don't want to make market risk or I don't want to take wild market risk. With that, decide number one, how long is your short term? I remember back in fall of 2008, Warren Buffett was being interviewed on CNBC. And the question to him was the market's, down quite a bit. I think it was maybe down 30% or so at the time. What should people do with their money? And Warren Buffett says, they should do the same thing they should always do. If you need money in the next 5 years or so, put it in the bank. If you need money longer than 5 years from now, put it in the stock market. Of course, you got to decide if 5 years is the right level for you. And when he says put in the stock market, I think Warren Buffett's literally putting the money in the stock market 100%. But you've got to decide if that's the right level of risk. If you want less than 100% in the stock market, which is most people I run to when they hit retirement. So step one is figure out how long is your short term. Step two is to figure out when you plan to retire. It might be that you decide that 5 years from now is your short term, as in, if I need money 4 years from now, I don't want to worry about the market dropping with that money. And what if you want to retire then 3 years from now? Well, that 3 years retirement is within your 5 year short term time frame where you might want to start planning for retirement ahead of time. I encourage you to start planning for retirement ahead of time for a couple reasons. One is that people retire earlier on average than they expected. You ask a 55-year-old when you think you'll retire, they'll tell you 65. But when you ask a 65-year-old, when did you retire? They'll often tell you 62. On average, you might retire 3 years ahead of time. So even when you're planning out, I want to retire a certain amount of years from now, maybe get your money ready ahead of time because on average, you're probably going to retire ahead of time. That's one reason to get ready. Another reason to get ready ahead of time with your retirement is I've talked to a lot of retirees over my 20 years as a financial advisor, and it seems like it's a lot easier. It's a lot more fun to go into work when you know you don't have to go into work. When you're going into work and you feel like I need to get this paycheck next 2 weeks so I can live, that's a dread. That's not a fun situation to be in. But when you go into work knowing I could quit anytime I want because I'm already ready for retirement, I know what my plan is going to be. It just sometimes just takes the pressure off. Oftentimes you can feel better about work. You might even work longer, add some more cash to your retirement if that's what you're doing. So step one is figure out how long is your short term. Step two is figure out when you plan to retire. And often you want to be ready for that ahead of time. And maybe you want to raise some cash to get ready for retirement. If you got this idea of short term and long term buckets, maybe having some cash on hand ahead of time, not the day you retire, but before you retire is a great idea. Just an example, if we said 5 years is your short term and you decide that you are planning to retire in 3 years, that means year four, year five, you're not working. That's money that you've got to rely on, take out of your investments. And maybe you want to set aside that money out of the stock market or bring down the risk on that. Maybe even put the money into cash. Say you've got 2 years worth, the market's at an all-time high, and because of your time frame that you figure out on your own, you've set aside 2 years worth of cash to get ready. I wish a few people I met back in 2020 had done something like that. I met quite a few people give you a call in 2020 when the market drops. Especially, we had a few people from Harley Davidson. I'm in Milwaukee, and in June of 2020, Harley Davidson announced they were cutting 20% of their workforce. And I remember two in particular where I'm talking to them in June of 2020. And what they told me is I was going to retire at the end of the year. Two separate people, not related. but boy, it sticks out when two people tell you this right in a row. I was going to retire at the end of the year. It's beginning of the year, and it was basically an all-time high back then in the fall of 2019 and end of 20 beginning of 2020. Market's at an all-time high. I'm retiring in 1 year, and I was mostly in the stock market. I was trying to ride it out till I retired, and then I would make a change. Well, then all of a sudden, my investments dropped 30% in about 2 months, so I moved it all to cash. Well, that did not work out too well for them because if you're going to retire in 1 year, I believe the market is likely to go up. If you look at the historical past, the market's up about 70% of the time over a 1 year period. But you want to retire 100% of the time. You don't want to rely on the stock market just for your retirement date. And even for them, they couldn't rely on the stock market for their retirement date. Their retirement date changed because they got let go when the economy changed. And so if they had just raised some cash ahead of time, got ready for retirement ahead of time instead of waiting until that specific retirement date, you feel like you can only be in the market till you hit retirement, then you can only be in cash type investments afterwards. I don't like that idea. Oftentimes, it's a mixture of two different things, and get ready ahead of time. So if you're looking at your short term and your retirement date is inside of your short term, maybe look at the year two, three, whatever those numbers are, and say, I want to set some money ahead of time. That's step three, is perhaps you raise some cash to get ready for your retirement. So that's your short term. But let's talk about the long term because you need to still check your risk level, especially when the market goes up. Your risk is probably higher than you signed up for. So, a few ways to think about risk. It's really just what's the level of ups and downs you're willing to put up with. I ask people two questions. The first is on a scale of 1 to 10, one being lowest risk, 10 being highest risk. How much risk do you want to take in your investments? Another way I look at it is would you rather have average risk, above average, or below risk overall? And I'll just give you kind of two thoughts on there. Get some good comments. I agree with some comments in here. That's great. Um, Great, some ideas that are being shared. The If you have the thought that you might be on a 1 to 10 level of risk, let's just go with a 7. Maybe that means you ought to have about 70% in the stock market. So let's just keep that in mind. Another way to think about it again is if you'd rather have average risk, above average, or below average risk. You'll see all kinds of articles. I just saw in the Wall Street Journal this weekend saying kind of 60-40, 60% stocks, 40% bonds is kind of your average level of risk. So maybe that's a starting point for you to think about. Well, if you start with 60% stocks 2 years ago, that might be more like 65 or 70% stocks right now with the stock market growing so much. You probably have higher risk than you had signed up for. So think about the level of risk you want to have. Make sure you have that level of risk or rebalance, which today with all-time stock market highs often means you're selling some stocks, moving it more towards bonds and cash. But keep in mind too, risk. You could have some very risky stocks, right? 70% in one stock is fairly risky. Or I met someone in 2021. He was 100% growth stocks, and he was a tough one because he was planning to retire about 7 years from now. So what do you do with that? He's kind of still in the long term area, right? It's 2021, still long term. Do you bring the risk down? Maybe you do because people retire earlier than they expected. But it's hard to argue with what's working. Except for him, he was 100% growth stocks. Of course, I suggested you should always have the right level of risk. He had too much risk. And in 2021, he's just thinking, what's this Jeremy guy know? The market keeps on going up in 2021. Well, in 2022, those tech stocks, those growth stocks, those are down 30, 35, maybe 40% at its worst point in 2022. So he calls me in January 2023, now that the market had dropped 30% in just a year for him. And that's when we started diversifying his investments. And of course, that's tough. Like, how do you diversify when the market's down so much? So we had to kind of do a little maneuvering and hopefully figure out, let the growth stocks maybe come back a little bit in 2023, but let's bring the risk down. It would have been a lot easier when the market's at a high point to say, let's get you the right level of risk, right level of short term if you need that overall. So that's step four, is to check your risk level even in the uh, growth stocks and the long term money, because whatever you sign up for when the market's at an all time high, it's probably higher risk today than it was when you signed up for it. And that brings me to the fifth step. Maybe lock in some income or lock in some rates. That seems to be a hot topic. I've gotten 3 emails just today about what should people do. These are from journalists. What should people do with their money now that the Fed is expected to stop to drop their rates? So step five is maybe you lock in some of your income, maybe you lock in some of your rates. This is all considering what to do, because if the stock market is an all-time high, what better time to cash in some profits? And of course, the market might keep on rolling, and I'm not predicting the market drops, but things are looking good. Of course, things only look good in hindsight. You don't know what's going to happen today or tomorrow or month or year from now on there. So when things are high, maybe you start locking in some of your income, maybe you start locking in some rates. And what I mean by locking in income is maybe you want to take your dollars, your investment savings, and lock it in some sort of income that pays you out over time. Now, typically, the best way to do that is to lock in your Social Security. When you wait on Social Security, you're actually somewhat buying more Social Security. So, for example, if you had 2,500 a month, which is 30,000 a year, that you're expected to get from Social Security today, and if you wait 4 years longer than you expected, uh, I'm not telling you to not live on that income, but what if you just wait 4 years on that Social Security? That's 30,000 a year you're not getting for 4 years. That's 120,000 that you still want to have the income. You still want to live on it. So one way to lock in higher income is by locking your Social Security. Maybe you take 120,000 from your growth area, put it more towards cash, live on that for the next 4 years. Well, 4 years later, you turn on your Social Security at 2,500 today, ought to be closer to about 3,300 in 4 years, which is about 40,000 a year. You're just locking in about 30% or more, 30 to 33% extra income by locking in your Social Security. You might already have maxed out your ability to wait on Social Security. You could actually maybe lock in with a lifetime income annuity. There's different lifetime income annuities out there. You might have an opinion on how annuities work, but the whole point of annuities is to take your dollar amount and turn it into an income that pays out to you over time. Um, Seems like it's worth considering when the market's at an all-time high and you're grabbing profit out, and you're also maybe buying in some of those annuities at a high point. Been an advisor for 20 years. Those payouts on the annuities, which you can get, are the highest I've seen since 2007, 2008. So at least 15 years, maybe longer. And of course, too, when I said you have short term money, that doesn't always have to be short term, like it's available tomorrow in a savings account or money markets. The top paying savings accounts and money markets today, late August of 2024, are about 5%. And I would say don't be fooled by those high interest rates. Those are great high interest rates. But if you think you'll need that money a year from now, 2 years from now, 3 years, maybe you ought to lock in for 1 or 2 or 3 years, which is tough to do because maybe you're at 5% in your high yield savings and you can get 5% for a 1 year rate, but maybe only 4.9 for a 2 year, 4.8 for a 3 year. It seems foolish to lock in a 3 year at 4.8 when you get your money market at 5. Well, if you're expecting rates to drop, then maybe locking in is actually a good idea. I remember back in 2008, 2009, 2010, 11, 12, people saying, if I could just get 6% on my money, I would lock it in. Well, that's because they could have got five, maybe six. That would have been tough, I think, but you could get 5% back in '07, early '08, even. And then all of a sudden, rates dropped close to zero, really, and they're kicking themselves. They're saying, "Oh, I wish I had locked in." So I don't think you should buy an interest rate just because it's a high interest rate, but you should always be in the right level of risk. And part of risk is when do you need the money? If you have short-term interest rate money and you need it 1 year from now, 2 years from now, 3 years from now, maybe locking in those interest rates for 1, 2, or 3 years are going to be the way to go. So those 5 steps, again, those 5 action steps when the stock market's at all-time highs, figure out how long is your short term. Look at when do you plan to retire. That's number 2. Um, Number 3 is kind of combine those together. Perhaps you raise some cash to get ready. You want to do this ahead of time. You want to plan out your retirement before you plan out, before you actually hit retirement. Step 4 is to check your risk level in the stock market, because whatever you sign up for is probably going to be a higher risk than you signed up for. And maybe, whether it's through Social Security, some sort of lifetime income annuity, or maybe even just standard rates like a CD, maybe lock in some rates, because you're probably selling some stocks at today's the all-time high in the Dow, and getting that money ready for whenever you need it. Perhaps you need it over your lifetime, and you might lock in some extra Social Security by waiting, or lock in with an annuity. Or maybe you know you need money 1, 2, 3 years from now, and you go find a rate that pays you out 1, 2, 3 years from now. Now, put a comment in there. I'll send you those 5 action steps, and also check the comments. Let me get that in there. I've got a YouTube video ready to go. How to get ready for a stock market crash early in your retirement. There it is. It's good to go. It's in there. Enjoy your day.